All right, let's dive in. Today, we're tackling the Rule of 40, a metric that gets thrown around a lot when talking about SaaS companies.
It can sound kind of intimidating, right?
Totally. But trust me, it's actually pretty straightforward once you break it down.
Definitely. And it gives you a really interesting way to look at how software companies balance growth and profitability.
Exactly. It's like a quick health check, to see if a company's on the right track.
Right. And it all boils down to a simple formula, basically.
Oh, you mean like those secret formulas they use in those old spy movies?
Uh-huh. Kind of. You take a company's revenue growth rate, add their profit margin, and boom, you've got their Rule of 40 score.
Okay, so not exactly rocket science then.
Not quite, but it's pretty powerful stuff.
So just to clarify, revenue growth rate, that's like how much the company's recurring revenue is going up year over year, right?
You got it. And profit margin, we're usually talking about EBIT for this.
Yeah, EBITDA, earnings before interest, taxes, depreciation, and amortization.
It's funny. Everyone uses the acronym, but nobody really wants to say the whole thing.
Too many syllables. But anyway, so what kind of score are we looking for here?
Generally, 40% or higher is considered a good sign. But here's where it gets interesting. A company could have incredible growth, like really amazing growth, but still be unprofitable.
Wait, hold on. So they can be losing money and still pass this test?
Yep. It's all about the trade-offs. If their growth is high enough, it can offset a negative profit margin.
Okay, now that's kind of blowing my mind a little bit. So a company in the red can still be considered healthy according to this rule. How is that even possible?
Well, let's look at an example from the article we're using for this deep dive. It's called High Growth SaaS, and this company has a whopping 50% revenue growth rate.
50%? That's insane.
Right. But they also have a negative 10% profit margin.
So they're growing like crazy but still losing money.
Exactly.
Yeah.
But because their growth is so high, their Rule of 40 score is still 40%.
So it's like they're investing everything back into growth, even if it means sacrificing profit for now.
You got it. They're betting on the future, hoping that massive growth will eventually lead to profitability down the line.
That's a pretty risky bet, isn't it?
It can be. But for some investors, that kind of aggressive growth is really attractive. It all comes down to risk tolerance and investment strategy.
I see. So this rule isn't just about a single number. It's about understanding the story behind the numbers.
Absolutely. And it's about knowing what's important to you as an investor or even as an employee at a SaaS company.
Yeah, because if you're working at a company that's laser focused on hitting this 40% target, you'll see that reflected in their decisions and priorities.
Exactly. It helps you understand the big picture, like why certain decisions are being made or what the company values most.
So whether you're thinking about investing in SaaS or working in the industry, knowing about the Rule of 40 can give you a real edge. It's like having a secret decoder ring.
I like that analogy.
It helps you decipher the language of SaaS and understand what makes these companies tick. Now, we've talked about this high growth example.
Right, the company with crazy growth, but negative profits.
But the article also mentions another example, mature SaaS, which shows a totally different approach.
Yeah, they're kind of the opposite.
They're playing the long game, right? Steady growth, high profitability.
Exactly. This company's only growing at 10%.
Much slower than that 50% we saw earlier.
For sure. But they have a 35% profit margin, so they're making bank.
So their Rule of 40 score ends up being 45, even higher than the high growth company.
Exactly. It just shows that there are multiple paths to success in the SaaS world. You can be the fast-growing disruptor or the steady, reliable profit machine.
It's like choosing your own adventure. So this rule highlights those different paths.
Then it helps us see that there isn't one right way to build a SaaS company. What matters is finding a strategy that aligns with your goals and risk tolerance.
This is all making a lot of sense, but I have to admit I'm a little skeptical about reducing something as complex as a business down to a single number.
Yeah, you're right to be cautious. The article actually talks about some important limitations to the Rule of 40.
Okay, good. I was hoping it wasn't just me.
Not at all. For one thing, a brand new startup shouldn't be judged by the same standards as a massive established company.
That's like comparing apples and oranges or maybe a seed to a giant oak tree.
That's a good one.
It just wouldn't be fair. Right.
Exactly. They're at completely different stages of their journey.
So context is key when looking at this rule.
Absolutely. And the industry matters too.
What do you mean?
Well, some industries are naturally high growth.
Like tech. Right.
Yeah, exactly.
Yeah.
But others are more slow and steady.
So you can't just apply the Rule of 40 blindly across all sectors.
Nope. You have to consider the industry norms and expectations.
This is starting to sound like a pretty nuanced rule.
It definitely is. And I think the biggest caveat is that it's still a simplification. It can't capture all the nuances of a business.
Yeah, there's so much more to a company than just its financial performance.
Right. Things like customer satisfaction, the competitive landscape, even the overall economy, those all play a huge role.
So the rule of 40 is a good starting point, but it's definitely not the whole story.
Exactly. You have to dig deeper, ask more questions, and really understand what's going on behind the numbers.
All right, so this rule is helpful, but it's not a magic bullet. We need to use it wisely and keep those limitations in mind.
Precisely. Now, speaking of digging deeper, the article also talks about some strategies that companies can use to improve their Rule of 40 score.
Oh, that's interesting. So there are ways to actually move the needle on this metric.
Yep. And they involve some pretty smart tactics like optimizing customer acquisition costs.
So basically spending less to get each new customer.
You got it. It's all about finding ways to make your marketing and sales efforts more efficient.
That sounds like a win-win. Lower costs and more customers.
Exactly. And there are other strategies too, like enhancing customer retention.
Keeping those customers happy and coming back for more.
Yep. And expanding their business with you.
Clever. So keep them happy and de-upsell them.
Exactly.
What else?
Well, there's also investing in operational efficiency.
Making things run smoother internally. Cutting out the waste.
You nailed it. Streamlining your processes so you can do more with less.
Okay, so that's like getting rid of the fat and making the whole operation leaner.
Exactly. And the final strategy is balancing growth investments.
So not just throwing money at every new idea that comes along.
Right. It's about being strategic and focusing on the initiatives that are most likely to drive sustainable growth.
So it's like choosing your battles wisely, focusing on the ones you can actually win.
Exactly. And the goal is to find that sweet spot where you can grow responsibly without sacrificing profitability.
This is all starting to click now. It's about finding that balance between growth and profit.
And the Rule of 40 helps us see how companies are doing in that balancing act.
Well, I think this has been a super helpful overview of the Rule of 40.
We've covered a lot of ground, from the basic formula to its strengths and limitations.
And we've even touched on some strategies for improvement.
But I have a feeling our listeners might have some more questions about how this rule plays out in the real world.
Totally. Like, how do you actually use this rule to make decisions? What are the potential pitfalls to watch out for?
And most importantly, is this rule really the be-all, end-all for evaluating SaaS companies? I think those are some great questions to explore in the next part of our discussion.
Sounds like a plan. Let's take a quick break, and then we'll dive even deeper into the Rule of 40.
You know, we've been talking a lot about what this Rule of 40 is.
Right, like how to calculate it,
Why it matters.
especially for SaaS companies.
But I think there's like a bigger question here.
Ooh, I like where this is going. What are you thinking?
Well, what if you focus too much on this one number?
Ah, I see what you mean. Could that actually be a bad thing for a company?
Exactly. Like, what if they're so obsessed with hitting that 40%?
That they forget about everything else?
Yeah. Like, imagine they start cutting corners just to boost their score.
Oh, I see. So like skimping on product quality to bump up those profit margins?
Exactly. Or like slashing customer support to save some cash.
Right. So their Rule of 40 score looks amazing on paper.
But in reality, they're hurting the business in the long run.
Yeah, it's like a crash diet, right?
Yeah.
So you might lose weight quickly, but
But it's not sustainable.
and it could even be harmful in the long term.
Totally. That's why it's so important to remember those limitations we talked about.
Right. The Rule of 40 is just one piece of the puzzle.
It's a snapshot, not the whole movie.
Love that analogy. It's like judging a book by its cover.
You can't really know if it's a good book until you actually read it, right?
Exactly. You gotta dig deeper.
And that's where the real work begins.
Okay, so let's say I'm wearing my investor hat and I come across a SaaS company with a stellar Rule of 40 score.
Impressive number, right?
Yeah, looks great at first glance. But what other questions should I be asking to make sure I'm not getting fooled by a shiny number?
Great question. First, I'd want to understand how they're getting their customers.
Their customer acquisition strategy.
Yep. Like, how much does it cost them to get each new customer?
And how long does it take for those customers to actually start making them money?
Exactly. If those acquisition costs are crazy high, or if customers are churning like crazy, that's a huge red flag.
Even if their growth is through the roof.
Especially if they're burning through cash to acquire customers who don't stick around.
It's like trying to fill a leaky bucket, right? No matter how much water you pour in, it just keeps leaking out.
Perfectly put. And then I'd want to look at their product roadmap.
Are they innovating?
Yeah. Are they developing new features that people actually want?
Or are they just coasting on what they've already built?
Exactly. A stagnant product can lose its competitive edge really quickly, especially in SaaS.
Right. It's a fast-moving industry. You got to stay ahead of the curve.
Totally. So even if they have a great profit margin today, if they're not investing in the future, that's a problem.
Another red flag to watch out for.
For sure. And finally, I'd want to get a feel for their team and culture.
The human side of things.
Exactly. Are they passionate about what they're doing?
Do they have a strong leadership team?
Yeah. Are they all rowing in the same direction?
Those things are harder to measure than a simple number, but
They're crucial for long-term success.
absolutely. So it sounds like what you're saying is measure what matters.
I like that.
The rule of 40 can help us measure growth and profitability.
But we need to make sure we're also paying attention to the things that drive real, lasting value.
Things like customer loyalty, employee satisfaction.
And a strong company culture.
Those are the ingredients that make a company truly successful, not just on paper, but in the real world, too.
Couldn't have said it better myself.
Well, I think we've covered a lot of ground today, haven't we?
We've really gone deep on this rule of 40.
We've explored its strengths and its weaknesses, and
We've even talked about some alternative metrics and strategies to consider.
but most importantly, we've encouraged our listeners to think critically about this rule.
To go beyond the surface and ask the right questions.
Exactly. Now, before we wrap things up, I want to leave our listener with one final thought. So we've spent all this time, getting to grips with this rule of 40.
Yeah, really dissecting it.
But here's a question I've been thinking about. Can a company that, only focuses on hitting this magic number actually build something that's going to last?
Ooh, that's a good one.
What LFEs should we be looking at when we're trying to, figure out if a company's really successful beyond just this one metric, right?
It's so easy to get tunnel vision, isn't it?
Totally.
Just fixated on that 40%.
Yeah, what if they're so focused on that number that they forget about, the human side of things?
Ooh, I see what you mean.
Employee well-being or building a company culture that people actually want to be a part of.
Totally. It's like you can hit that magic number, but at what cost?
Right. What if they create this, toxic work environment just to squeeze out a little more profit?
Or what if they, cut corners on employee benefits to save a few bucks?
It's it might look good on paper,
Yeah.
but is it really sustainable?
It's like building a house on a foundation of sand.
Ooh.
It might look impressive for a while, but eventually it's going to crumble.
Exactly. We have to look beyond just the numbers.
Think about things like customer loyalty,
Employee satisfaction.
ethical business practices,
Yeah, those things that actually create lasting value.
and make a positive impact on the world, right?
It's not just about making as much money as possible, as quickly as possible.
It's about building something that can thrive for years to come.
Something that people are proud to be a part of.
Exactly.
This deep dive has been so insightful. We started with this, seemingly simple formula,
Yeah, it seems so straightforward at first.
but we've uncovered so much more than that.
We've really gotten a better understanding of what it takes to build a truly successful company.
Especially in the SaaS world.
It's been awesome exploring these ideas with you.
Likewise. And to all our listeners out there, we want to hear from you.
Yes.
Now that you know about the rule of 40,
How are you going to use it?
what other factors do you consider when you're, sizing up a company?
Yeah, let's keep this conversation going.
Hit us up on social media, leave a comment, share your thoughts.
And keep diving deep.
Until next time.